Okay, we're just going to give it a moment as the attendance fills in, and then we'll get started. All right, great. I'm sure people will continue to join over the first minute or so, but I want to go ahead and welcome everybody. Thank you for joining us for our Q3 financial markets update. We're pleased, as always, to have Steve Galley, our Chief Investment Officer, with us today to share some insights on the current market and what it means. This session is designed to be interactive, so if you have any questions you'd like Steve's perspective on or to hear more about, please don't hesitate to submit them in the chat or the Q&A, and we can bring them up at the end and address them as best we can. So thank you again, everyone, for being here. And with that, I'll hand it over to Steve.
Thank you, as always, Katie, and thank you all for joining us today, especially those on live. And by all means, ask questions. That's what makes the live presentations more fun and interesting. So we do have a lot to cover today. We will try and keep it very tight to hopefully a half hour or less. And if it seems like it's been a while since I presented, it has, because normally we present in the month of August on our quarterly cadence, but because of the big transition we went through moving from Avantax to Cetera, we pushed it out a month. So thank you all for your patience as we navigated that transition. And I'm going to talk a little bit about that actually in a few slides. So let's get right into it. What I'm going to cover today is, if anyone ever read that book, Who've Moved My Cheese? It's change is constant, right? We always have to deal with change. We need to embrace it, not run away from it. I'm going to talk about what's happening in the market, as well as what that ultimately means for portfolios and the investment strategy here. And then at the end, we'll have hopefully some lively Q&A. So I guess one question, and many of our clients who have gotten a lot of notifications, is that we have changed broker dealers. We moved from what was Avantax, which was our broker dealer, now to Cetera. So for many people, a lot of questions were, well, who is Cetera? Cetera is actually one of the largest independent broker dealer firms out there. So they are focused on providing a platform for firms just like ours to be able to do our investment management, our trading, our statements, our compliance, all those great things that happen behind the scenes. And ultimately, Cetera is a private company. They are backed by private equity money. And what's been happening in the space that we operate in is that firms like Cetera are acquiring other firms to scale up, because in our business, scale is very important. And also, when you acquire, you're usually able to generate a lot of cost savings. So what do I mean by that? Well, as an example, when Cetera acquired Avantax, Avantax had their own chief investment officer, and Cetera has their chief investment officer. That's no longer the case. Avantax's chief investment officer is no longer needed. So that's an example of the type of consolidation and cost savings that can happen in these acquisitions. So, and it's not just limited to Cetera. There are other firms out there that are buying up independent financial advisors because, and it's interesting to note that actually the number of financial advisors in this country is slowly decreasing. That's because a lot of them are retiring as they get older, and they are not actually being replaced fast enough. But the independent advisor space is still growing. And one of the reasons is, and one of the reasons we love being independent is, as opposed to working for, let's say, a big corporate firm or a big bank, is that it allows us to have the flexibility to run the business the way we think is best and is best for the clients. We don't have a corporate agenda we have to stick to. And we really appreciate the fact that we can have that flexibility as an independent firm. And I think our clients appreciate that too. And that's why the independent channel in the advisory space overall has been growing, and why so much private equity money has been going after that independent advisory space. So that's kind of what's been playing out in the industry. And so it's actually ideally a good thing that we now have one of the largest broker dealers servicing us, because ideally that means that their technology is better, and hopefully you as clients can benefit from that better technology platform. So more to come on that. But again, we appreciate your patience as we made that transition from one broker dealer to another, because I know that not everyone loves getting so much mail when things like that happen. Now, a few other things have changed, and that's really in terms of terminology. So I wanted to make sure I covered that with everyone. And so I wanted to dig into risk. And so for many of you who have, are in meetings with me, you know that one of the things I always focus on is really understanding what type of risk are we taking for this particular account or overall. Because in the investment world, the more risk you take, ideally, the more rewards you get, and vice versa. The two are very correlated. So we always really make sure that we want to make sure we have the risk that is appropriate for you or a particular account. And we have a scale to grade what risk is on the account, which then also should ideally correspond to the expected returns. So every single account that we manage has a risk profile. And it's actually, this is a snapshot from one of our systems for a particular account. And in this particular case, this account has it's targeted to be moderately aggressive, and the arrow is telling us that it is pretty much spot on to that moderately aggressive risk profile. But in the old days, we used to call this piece of the pie growth risk. The new term is moderately aggressive. So what do I mean by that? Well, I know this is a little small, but I always talk to people about risk on a scale of basically 0 to 5, right? 0 is I really don't want to take any risk at all. 5 is I want to take as much risk as possible, right? I want to be really aggressive. So our old nomenclature in the Avantax days, when we talked about risk levels, was if you were a 5, that was aggressive growth. If you were a 4, growth, 3 moderate, 2 conservative, and 1 was ultra conservative. In the new regime, the terminology of risk has changed. So if I or the advisors talk to you about risk and we're using different terms, I wanted to make sure that everyone understood that it's really just changing the term. It's not actually changing the risk level itself. So aggressive growth is still aggressive growth, but instead of the growth category, which was a 4, now we call it moderately aggressive. Moderate, which was a 3 risk, is still moderate. Conservative, which was a 2, now it's called moderately conservative. Clearly, the Cetera folks love the word moderately. And instead of ultra conservative being a risk 1, now we call risk 1 conservative. So just to make sure that everyone's on the same page about those risk terminologies, and if you think about it, we do have flexibility within each category. So for example, if you are a risk 2 or moderately conservative, what that really means is your equity exposure can range anywhere from 30% of that particular account all the way up to almost 50% of that account. And so the nice thing about that is if you're feeling like you want to be more conservative within the risk 2 zone, you can go all the way down to 30% equity. Or if you feel like you want to be more aggressive within the risk 2 zone, you can go all the way up to almost 50% equity exposure. So that's kind of the latitude we have within each respective risk category. So that's just some of the nomenclature changes that I think it's important that everyone's aware of as we move forward. Because as you know, whenever we're setting up accounts, we always want to make sure that the risk level is appropriate given the objective of that account, as well as the objective of you, the client. Okay, so, and we did get, I saw a few questions that were submitted in advance of the presentation about, the Fed and what's going on and what does it mean and what we're doing. And, the Fed obviously cut rates last week by 25 basis points. That was very much communicated in advance. The market expected that. And that's exactly what happened. I would argue that the Fed is not done cutting rates, although I'm not necessarily sure that's a great idea, given the fact that we still have what I would argue to be somewhat of an inflation problem. So we'll talk a little bit more about that. Let's take a look at some of the more headlines. And it doesn't really seem to matter what happens these days. Nothing is able to shake this bull market. This is a strong bull market. We hit an all-time high in the markets last week. And it seems to be that investors are really embracing the market. Nothing seems to make anyone run for the hills anymore. And that optimism is running rampant. But getting back to sort of the inflation discussion and a lot of this tariff discussion, which is always in the headlines, the collective wisdom upon Wall Street is that this tariff impact on inflation is not going to be large. And if it does have an impact, it will only be short term. And so part of the argument of that is if you do put a tariff on something, let's say you as a consumer have $100 to spend, and one of the things that you spend that money on had a tariff slapped on it, which means the price goes up, so you have to pay more for it. So people would say, well, of course, tariffs are going to cause inflation. But the problem is you have $100 to spend. So if you spend more on the good that had a tariff, you have less to spend on everything else. So that gets into the more of the argument that longer term tariffs don't have a dramatic impact on inflation because everyone's spending adjusts accordingly. In other words, if you spent more on the goods that had tariffs, you just spend less on other stuff that don't have tariffs, and that balances out, not causing inflation. Now, that's kind of a simplistic argument. I'm not sure I actually 100% agree with that, but that's one of the theories as to why inflation is really not being dramatically impacted by tariffs. And if you actually look at this chart, we had obviously a huge inflation problem in 2022, and that actually triggered a pretty big market meltdown in 2022. But as you can see, we've been hanging around the 3% inflation level for basically over a year and a half. So you can't really make the argument that tariffs have been causing this persistent inflation because we've been kind of stuck in this 3% zone for quite a long time, way before this whole tariff kerfluffle started. So there's something else going on in terms of inflation. And in order to understand that better, I think we always have to look at what's going on in the labor market. And so I love the way Wall Street always comes up with terminology to kind of phrase what's going on right now. And right now, the terminology is our employment market is in a low hire, low fire situation. So companies really aren't laying off that much, but they're also not hiring that much, which is why the unemployment rate by historical standards is still hovering at, relatively low levels, just above 4%. However, I think part of the issue that's happening and why inflation is remaining a problem is because wage inflation is actually pretty high by historical standards. And one of the reasons wage inflation is kind of high is because ever since the pandemic, the cohort of workers aged 55 years or older have dramatically reduced or dropped out of the workforce. Now, I'm not one of those people. I'm still working, but in general, a lot of people who are 55 years and older have chosen to exit the workforce. And those people and their qualifications are actually very, very hard to replace. You can't just take the wisdom of, let's say, a 58-year-old lawyer and replace them with a 27-year-old paralegal. So that is what is actually causing wage inflation, because in the quest of companies trying to replace a lot of these 55-plus-year-old job situations, they've been having a hard time doing that, and they've been having to pay up to find those replacements. So that, I think, is somewhat of the explanation as to, even though unemployment is still seemingly tame, why do we have higher wage inflation, which is driving that's why we have higher wage inflation, which is ultimately driving that inflation number, which is making it really sticky around 3%. And that's a problem for the Fed, because the Fed has been saying that their target is 2%. So now some people are saying the Fed, in essence, is sort of abandoning that 2% target, because I think they realize that the only way they're going to get to that 2% inflation target is if a recession is induced. And I don't think they want to do that. So that, in some respects, is tying the hands of the Fed. So it's a tricky tightrope that they are trying to walk. Now, the markets, of course, love when the Fed is on a cutting rate cycle, because when the Fed cuts rates, financing is cheaper, especially in short-term financing. That allows more investment activity, more risk-taking, and equity markets love that. And of course, there's no surprise that right now we have equity markets bouncing around at all-time highs. We always get the question of, oh my gosh, if the markets are at all-time highs, should I, not invest, or should I sit on the sidelines? Well, and the statistics tell us the answer to that is no. There is really no strong argument to be made to not invest even when the market is at all-time highs, because that gets into the concept of momentum. And what data tells us, and hopefully this chart makes it pretty clear, is that even if you do invest at all-time highs, you actually do just fine, if not better, in the subsequent 1 year, 3 year, and 5 years in terms of your returns. And the bottom line is, and we always say this, it's not about timing the market, it's time in the market. So just because the market is at all-time highs doesn't mean that you shouldn't be investing, and the data actually proves that out. The other thing to keep in mind is, if you do stay on the sidelines, and if you have your money parked in cash, for example, well, that ultimately hurts overall in the long term on your returns. So what this tells us is that, and this kind of chart goes back to 1995. So this is basically a, looking back 30 years of what would happen if you invested $10,000 in various asset classes. And so the bottom line is, if you invested $10,000 in large cap or small cap stocks, you pretty much made 8 times your money. So now that would be worth close to 80,000. Bonds, you a little more than doubled your money. So not bad. Bonds did their job. But cash, if you sat in cash, you actually lost money. Now, this is on inflation-adjusted returns, meaning that after you account for inflation, if you just sat in cash or money markets, you're down, right? Because inflation ate away at whatever returns you were getting sitting in those short-term instruments, right? So this really is telling us that, again, it's not timing the market, but you really need to be in it to start getting that power of compounding over time with your investments. And speaking about what the markets have done year to date, and I highlighted the middle column here, and looking at, what's been leading the way. And we always preach diversification is important. And this year has really proven that out, because international markets have been very strong. So, while the S&P 500 has been up close to 14% this year, a little more than that as of, a few days ago, international markets have almost doubled that, right? And so not only have they had strong performance, but they've also had the tailwind of a weaker dollar. So when the dollar is weaker against other currencies, that's really good for international stocks. It basically causes their returns to be even higher. And one of the reasons behind that is, as we mentioned, the Fed is on a cutting cycle, right? Other central banks, Europe in particular, are not. And so that has an impact on currency valuations. And so the fact that we're on a cutting cycle and other countries are not is one of the other influences on the dollar. And I don't think anyone expects that dollar weakness to reverse anytime soon, because the Fed is still entering into a cutting cycle. So that's one of the reasons why we've been happy that, we have had most of our clients internationally diversified. But, it doesn't really matter where you were this year. I mean, you're doing fine. Everything is up. Everything has been pretty strong. And as a reminder, this has followed, two really great years in both 2023 and 2024. So, again, the bulls are running rampant, and it doesn't really seem like anything is slowing them down. I think this is an interesting chart here, just to take a look at the S&P 500 since 1997. And this is, we always talk about valuation. Now, back in 2000, right before the dot-com bubble burst, and hopefully many of you on this call remember that, the forward PE ratio, meaning how much you had to pay for every dollar of earnings in the stock market, was over 25 times. That is incredibly expensive by historical standard, and that was a pretty good signal that things were overinflated. And sure enough, the dot-com bubble burst, and we proceeded to have a 49% decline top to bottom over the next several years. That was very painful, recovering from that dot-com bubble. Now, the forward PE ratio back before the great financial crisis was only 15. That actually is a reasonable valuation for the market, but that recession was caused by the housing crisis. That was a housing bubble, not a stock market bubble. That caused actually the largest decline we've seen in the last several decades, peak to trough. That was over a 57% decline. Then we began the long, amazing march up. And as I just mentioned, what happened in 2020? Well, we had COVID, but we also snapped back. So that was a quick drop, followed by one of the quickest recoveries ever, right back up to when we had a big inflation problem in 2022. And remember, in the inflation chart, we saw that inflation was approaching 10%. That caused a big problem. Stocks didn't like that. But again, once again, we've always recovered. And this time we recovered pretty quickly. And here we are at a PE ratio of about 22.5. So are things expensive now? Yes. 13 months ago, things were pretty expensive. And we had been talking about, caution might be in order. But here we are today, and things are even more expensive. So to be fair, our cautionary stance has actually not paid off. But I actually am not throwing in the towel. I don't think that, I still think caution is in order. Things are even more expensive today on a forward PE basis. And I think we have to be really wary of that, because there are a couple of things out there that make me a little nervous. So I'm going to get into those right here. So I think it's also interesting to talk about, well, oh my gosh, could the stock market crash from these levels? And the answer is, of course it could. But it's interesting to look at, well, what really causes crashes? Like, what have we learned from the last couple of crashes, at least? What happened before the dot-com bubble crash was free cash flow was deteriorating in a lot of companies. And free cash flow is really a measure of, after you pay all your expenses, what do you have left over as a company? That's free cash flow. And that was deteriorating fast before the dot-com bubble burst. The other thing that was playing out was that the IPO market, or the initial public offering market, was really hot. Companies were going public left and right, raising capital like crazy. That happened before the dot-com bubble. So are we seeing some warning signs? Well, we just talked about what happened to free cash flow before the dot-com bubble burst. Free cash flow is falling among some of the big tech companies. And the term on this slide is hyperscalers. And the hyperscalers refer to the companies that are building out their artificial intelligence infrastructure as fast as they possibly can. The Metas or Facebooks, Googles, Amazons, Microsoft, and now Oracle has joined the ranks of the hyperscalers. And their free cash flow is falling a bit. That's a little troublesome. The IPO market this year is actually also very, very strong. Stronger than it's been in many years. And this is actually showing that we've reached the level of IPO activity of all of last year, and we're not even done with this year. We still have more than a quarter to go. So clearly this year is going to be better than the last 4 years. That sometimes signals that things are getting a little frothy, and you don't have to look too far to see some of these IPOs that have come out recently. And even in the non-IPO market, like Anthropic, which is an artificial intelligence company, they just raised funding that valued them at $183 billion, and that's a private valuation. That's actually makes them more valuable than probably the top 50, that makes them in the top 50 of all publicly traded companies. That sometimes can signal a market top. StubHub, I don't know if any of you go to sporting events or concerts, but StubHub did an IPO this year, and it keeps on going. NVIDIA, the largest company in the world, just actually invested $100 billion into a private company known as OpenAI. Now, I've talked about OpenAI before. Who are they? They are the company that is behind the famous ChatGPT. And if you've never tried ChatGPT, I encourage you to try it. That is an incredible tool, an artificial intelligence tool where you can ask it to, I ask it to do complicated models for me, and it spits it out in about 5 seconds, which is, really an impressive feat. So NVIDIA just invested $100 billion into OpenAI, which I think is, incredible. And as I said, the IPO stock market is, this was a cover of Darren's only a few days ago. The IPO stock frenzy is just getting started. So I would argue that some of the signs of a bubble are there. Are there any others we should talk about? Now, remember when I said we'd look at the labor market again, and this is courtesy of Apollo, a big private equity firm that has their pulse on a lot of companies that they invest in across the country. They're now saying that we now have more unemployed people than actual job openings, which is the first time that's happened since, before 2021. I would argue that actually shows there's some weakness there, right? So again, definitely things that are signaling reasons to be cautious. And everyone talks about AI, right? And I have talked about AI extensively in the sense that a lot of the counter argument to these concerns and worries is that artificial intelligence is going to revolutionize the way companies do business, the way people do business, and it's going to drive company profits and productivity higher, which is going to drive earnings, which is why the market is so excited. And that's a reasonable argument, because I do think the AI trend is just getting started, and the benefits of that, I'll call it like super tech cycle, is just getting started. But I think this chart is pretty interesting. If you look at, and this is 10 companies, just 10 stocks since 2016. This shows their percentage of the S&P. And back in 2016, these 10 stocks, which are considered AI-related stocks, again, Amazon, Google, Meta, Nvidia, Oracle, et cetera, they were about 10% of the total S&P index. So in other words, 10 stocks made up 10% of the S&P 500, and the other 490 stocks made up the other 90%. Now, those 10 stocks account for 35% of the S&P 500 market cap. That's a massive quantity of market cap concentration in a very small number of stocks. I do think that poses some risks. I'd much rather see a more broad-based of market cap spread there. So again, I don't think that's a good sign. So ultimately, what are we really paying attention to? And we talked a little bit about what the bulls are saying. Hey, they're saying, hey, all this tariff concern, don't worry, tariffs aren't inflationary, and ultimately inflation is coming down. Well, inflation did come down from the big problem we had in 2022, but it hasn't come down to where the Fed wants it to be at 2%, unless, of course, as I mentioned, the Fed has kind of said, you know what, we're cool with 3% for a while, right? Corporate earnings have been strong. And if you listen to earnings reports, everyone mentions artificial intelligence in terms of they're investing in it, they're leveraging it, and that's driving a lot of cost savings as well as productivity gains. And that's shown up in corporate earnings. They've been strong. And as I always said, that's what you're paying for when you invest in stocks. You're paying for the future earnings potential of the companies that you're investing in. And those earnings have been good, and they're expected to stay pretty good throughout next year. And bulls are also saying that, you know, the consumers who are in, I'll call it the top 10% of economic earnings, are driving a lot of the economy. They are still spending, they're traveling, they're eating out. And yeah, it's more expensive, but they have the money because the markets have been great. So they actually have been able to keep up their spending. And of course, the Fed is cutting. And when the Fed cuts, that's always usually a good thing for the Fed. I mean, for stocks, and it's also usually a good thing for the housing market because it stimulates activity. People refinance, people buy new homes. And actually, the housing market has really been kind of stuck because of those high interest rates. And now maybe that's going to loosen up a little bit. And so that's kind of the bull's argument. But on the bearish side, and count me a slightly bearish here, is that inflation's still a problem. As a matter of fact, I really hope inflation doesn't keep going up, you know, from 3% to maybe 3.5%. I think that's going to be a problem. And if the Fed keeps cutting rates, that's only going to make inflation worse. As I said, stocks, you know, and market capitalizations are highly concentrated. That can be a problem, and that's usually not sustainable. You know, the weaker US dollar is usually not good overall for our economy in terms of economic growth. Unemployment, while it seems like it's low by historical standards, we have seen it start to creep up. And as I said, you know, there are some warning signs that, you know, this low hire, low fire may not be sustainable. And maybe we're going to see actually higher firing rates moving forward. And then, of course, there's the argument that maybe all this artificial intelligence hype is hype and not the real deal. And that, you know, actually we are experiencing a bubble akin to what we saw back when the dot-com bubble burst. But to be fair, a lot of those dot-com bubble stocks, they really didn't have strong earnings. The companies that are leading the AI revolution today have really good earnings. So that is a big difference. So just to be fair and counterbalance that point. So overall, what that means for strategy is we do have that, you know, when you go to the beach and you see that cautionary flag because, you know, either there's too much surf, you know, the surf's too strong or there's a rip tide. We are going to proceed with caution. We do want to lean a little more conservative than our respective benchmarks. And look, I have to apologize. You know, that has actually not paid off. We have been leaning a bit more conservative for a while now. So that ultimately means that we therefore will lag a bit compared to a benchmark, because if we're a little more conservative, then we won't get all the upside, right? But usually we're comfortable with that stance, especially because we'd rather miss a little bit on the upside and protect more on the downside. As I was saying, we are definitely maintaining that global diversification in portfolios. That's actually been great to make sure, and I have to say, a lot of the portfolios that I do see of outside of our firm, when I'm analyzing them, usually their international exposure is pretty low, and whether that's because they haven't rebalanced or whatnot, but that's definitely hurt this year. And then I think we're going to stay generally neutral on fixed income. Now, bond yields in general are high by historical standards. But the spreads, in other words, what I'm being paid to take on credit risk of a corporate bond over a treasury is very tight. As a matter of fact, if I buy, you know, one of the only AAA corporate bonds out there is by Microsoft, and the Microsoft corporate bond is literally trading almost at the exact same level as the U.S. Treasury bond. So you're really not getting paid much to take on that credit risk of investing in a corporate bond. But we're, you know, doing our best to manage through that. So that's why we're going to stay fairly neutral on fixed income. But as we have been saying, for our clients who are in the higher tax brackets, muni bonds are still quite attractive because on a tax equivalent basis, the fact that if you're a New Jersey resident, for example, and you're in a New Jersey muni bond, you're going to be getting both federal and state tax-free interest on those muni bonds. And if you're in a high tax bracket, the tax equivalent yields are very attractive by historical standards. So we've been definitely counseling clients a lot on that. So that's pretty much what I wanted to cover today, just a little over 30 minutes. Hopefully that was informative. And if there are any questions, I am happy to take them.
Great. Thank you, Steve. That was very informative as always, and we appreciate you sharing your presentation with us. We do have a couple of questions. One person asked, should we expect a high risk of stagflation?
So that gets into, well, first of all, what's stagflation?
Yeah.
So stagflation is the phenomenon when you actually have inflation that is higher than you would like. And in this case, I would argue anything higher than the Fed's 2% target is higher than we would like, coupled with an economy that is actually slowing down or not growing, right? So stagnation in the economy with inflation. And I do think that is a possibility. Um, again, if the Fed is entering a cutting cycle, I can't possibly imagine how that is going to cause inflation to go down, right? Then again, if the Fed doesn't cut and we start to see employment still show more weakness, and then we have a problem too. So I almost feel like the Fed is saying, am I better off not worrying too much about 3% inflation and avoiding what I think could be recessionary indicators? Or do I, so, and I think that's what they're saying. I think they're saying, I'd rather, and they would never say this, of course, but I would rather be comfortable with 3% inflation, but avoid a recession, right? And so that's kind of the tightrope they're walking, which might walk them right into a stagflationary environment. So only time will tell on that, but that certainly would be probably a bit problematic if we started to see the stagflation play out a bit.
Great, thank you. Another question, and someone submitted this beforehand, and you did address the Fed in your presentation, but just to reiterate, what are your thoughts with all the Federal Reserve drama going on? What, if anything, are you anticipating in the market's reactions to the drama?
Right. I mean, yeah, and I do think I covered most of that. But I think that again, the market has already priced in basically 2 more rate cuts this year. What does that mean? It means that the market is expecting the Fed to cut by another 0.5% by the end of this year. That would bring short-term interest rates down to closer to what perhaps people refer to as a neutral rate. Neutral meaning they're not in restrictive territory, meaning the rates are too high and slowing things down, but they're not in stimulative territory, meaning rates are too low and increasing overheating things. So that's kind of the way the market thinks things are going to play out. But the market's also anticipating more cuts in 2026 beyond the other 0.5% that may occur this year. So again, that's the equity market loves that. Rate cuts are great for stocks, but not necessarily great for inflation, and they may be tricky in terms of causing other unintended consequences. So time will tell, but we'll keep an eye on that.
Great. And unless anyone else has any additional questions, this will be our last one. But clients often ask us what you are watching most closely, Steve. So can you tell us what you are doing with your portfolio?
My portfolio. Yes, I like to say that I practice what I preach. And so, a lot of times we talk about rebalancing with clients and how I actually believe one of the most important things you can do in investing is be disciplined. And by disciplined, it means that you always rebalance on a regular basis. And so what does that really mean? It means essentially that you sell into strength and you buy into weakness. Because if, for example, in the last quarter, my portfolio has gone up nicely because I have a big, healthy allocation to stocks, well, I can sell a little bit, take some off the table from stocks and get back to my allocation before the quarter started and put that into something else that maybe hadn't had as good a returns, just to keep my diversification consistent, right? And so that's really what the discipline is, just selling into strength and buying into weakness. And that's what we try and do for all of you. And that's definitely what I do personally. And sometimes, you do have regret and you say, oh gosh, I wish I didn't take some money off the table because it keeps going up. But it's, as I said, it's always easy to be a Monday morning quarterback. So that's really what we think is most important.
Great. Thank you, Steve. All right. That I think wraps up our questions for today. I just want to thank you, Steve. These sessions are always so informative, and thank you to everyone who joined us and contributed your questions. It makes all the difference in these presentations. So we hope you found it helpful. As always, please reach out to us if you have any additional questions. And just to note, while we have you, our Q4 webinar is scheduled for Thursday, November 20th. So you can look out for an invitation from us. A little under 2 months, but it'll come up quick. So we look forward to seeing you at our next update. And thank you again, Steve.
Thanks all for listening. Until next time.
Have a good rest of your day.